Inflation-proofing investments, expert strategies for navigating 2025 shielding portfolios against inflation. As 2025 begins, investors are bracing for a year marked by potential economic turbulence, including inflationary pressures and rising interest rates. To navigate this uncertain landscape, financial experts are turning to defensive strategies designed to protect portfolios from eroding purchasing power while seizing growth opportunities, from hedge funds focusing on interest rate swaps to investments. In real assets and emerging markets, a variety of approaches are being deployed to inflation-proof investments. This story explores insights from leading financial minds such as Lippmann, Mina Pacheco Nazemi, and others, offering actionable strategies to help investors make informed decisions in a challenging economic environment. Interest rate swaps and defensive hedging. One of the most compelling strategies for 2025 comes from Lippmann, renowned for his role in predicting the 2008 financial crisis. His hedge fund, Max Capital, is emphasizing interest rate swaps to hedge against the possibility of a sudden rate surge. Interest rate swaps allow investors to exchange fixed-rate payments for floating-rate ones, providing flexibility and protection against rate fluctuations. This strategy reflects a cautious approach to an environment where central bank policies could rapidly shift to combat inflation. Interest rate swaps are particularly valuable for institutional investors seeking to manage large debt portfolios. For individual investors, this strategy underscores the importance of incorporating assets with lower sensitivity to interest rate changes, such as short-term bonds or floating-rate funds. Lippmann's approach serves as a reminder that proactive risk management is crucial in uncertain times. As inflationary pressures remain a global concern, this method offers a blueprint for those looking to safeguard their portfolios without abandoning growth potential. It also highlights the importance of understanding the nuances of financial instruments that go beyond traditional asset classes. Real assets, a tangible inflation. Hedge Mina Pacheco Nazemi, Managing Director at Barings, advocates investing in real assets like data centers and renewable power projects as a robust hedge against inflation. Real assets derive their value from physical and tangible properties, making them less susceptible to inflationary erosion. Data centers, for example, are critical infrastructure in an increasingly digital economy, while renewable energy projects benefit from long-term demand and government incentives. These investments also align with the macroeconomic expectations tied to the Trump administration's policies, which may prioritize deregulation and infrastructure spending. By focusing on real assets, investors can position themselves to benefit from sectors that are not only inflation-resistant, but also poised for structural growth. Real assets offer the added advantage of diversification. Their performance often correlates less with traditional equities or fixed income, providing a stabilizing effect in volatile markets. For retail investors, real estate investment trusts, REITs, or renewable energy ETFs offer accessible ways to tap into these opportunities without the need for large capital outlays. Shifting focus to emerging markets and fixed income. Will Smith of AllianceBernstein suggests a strategic pivot from high-yield U.S. corporate bonds to emerging markets and short-term bonds. This shift reflects a growing consensus that emerging markets may offer better risk-adjusted returns in a high-inflation environment. Countries with more robust growth trajectories or favorable demographic trends are likely to provide attractive opportunities for investors willing to accept slightly higher risks. Short-term bonds, on the other hand, provide a cushion against interest rate volatility. Their shorter duration reduces exposure to rate hikes, offering a safer harbor for conservative investors. Smith's strategy highlights the importance of tailoring fixed-income investments to current economic conditions, particularly as inflation erodes the real value of longer-term debt instruments. Meanwhile, Sonal Desai of Franklin Templeton emphasizes the need to stay invested in fixed income despite limited returns expected in 2025. For many investors, fixed-income assets remain an essential part of a diversified portfolio, providing stability and predictable cash flows. The challenge lies in selecting the right instruments to balance yield and risk, whether through actively managed bond funds or inflation-linked securities. Conclusion: prepare preparing for a challenging year, inflation-proofing portfolios is more critical than ever as 2025 presents a mix of opportunities and risks. Strategies such as interest rate swaps, real asset investments, and shifts toward emerging markets and short-term bonds illustrate the diverse ways investors are navigating these economic headwinds. Experts like Lippmann, Mina Pacheco Nazemi, and Sonal Desai offer valuable insights into building resilience while maintaining growth potential. For investors, the key takeaway is clear: flexibility and diversification are paramount. Whether it's adopting proactive hedging strategies, exploring tangible asset classes, or rebalancing fixed income allocations, a thoughtful approach can help mitigate risks and capture opportunities in a turbulent market. Stay informed with us for the latest investment strategies and expert insights to help you make confident, well-informed decisions in 2025.